The whiplash continues on Wall Street. Stock futures are down across the board for all major indexes ahead of today's opening bell. And this comes after markets rallied yesterday to claw back some of the heavy losses from last week. Kellogg says that it's splitting into 3 companies. Each business will mainly focus on cereals, snacks, and plant-based foods. And this comes after the company made more than $14 billion in sales last year. And several major investment banks are increasing their projections about a recession, including Goldman Sachs and Citigroup. Goldman now says that there's a 30% likelihood that we will see an economic downturn sometime soon. That is up from 15% that it projected earlier this year. So here to discuss is Emily McCormick. She's a senior reporter for Yahoo Finance. Emily, I'm really glad that you are here because I need you to explain this to us. For those of us who are not finance insiders, can you give us the basic understandings of what metrics or numbers analysts are looking at to make these predictions? Because, you know, I will point out, I think it was like 15% in the next year, and then it jumped to 30% in the next year. But then in April, they said 35% chance of a recession in the next 2 years. So what are they looking at?
Well, first of all, to your point, and what you were mentioning in the intro was absolutely correct. Goldman Sachs is among the major Wall Street banks that is now raising its probability of a recession over the next year and the next 2 years. Now, what's really important, I think, for viewers to understand is that the base case of a recession, so that's typically defined as 2 negative quarters of GDP growth, is not necessarily the baseline. It's not necessarily being seen as inevitable among these major Wall Street firms. But what they're saying is that the likelihood, that probability of the U.S. economy actually entering a downturn over the next couple of years has increased. Now, the reason that firms like Goldman Sachs, like Citigroup, and like Bank of America and Deutsche Bank are really talking about is that there is this risk that the Federal Reserve is going to actually over-tighten, that they're going to raise interest rates too fast and too quickly in order to try and bring down inflation, which is, of course, an imperative here when we do have inflation running at more than 40-year highs. But at the same time that these interest rate hikes are going to come at a pace that the economy isn't necessarily going to be able to keep up with. It's going to be raising these borrowing costs for businesses and consumers to the point that we are going to actually see negative GDP growth. So that really is the risk here. Again, really want to emphasize that the risk of recession is going up, but it's certainly not being seen as an inevitable at this point based on these forecasts.
Now, you know, these banks have their own interests and concerns, and they're not necessarily the same as mine. What is the benefit of having this sort of information for someone like me, for the average American? Is there any action that we should be taking or change that we should be making in our spending habits in order to protect ourselves?
Well, I think when it comes to recession risk, for example, of course, the purpose of this and the purpose of these probabilities is not to generate any kind of fear or anything like that, but it really is to try and inform investors, try and inform their institutional clients for the banks and the average American consumer about what the future may actually hold here based on the current inputs. Now, of course, we know, for example, the labor market is still extremely tight. There are about 2 job openings for every unemployed person still in the economy right now. That unemployment rate is still around 3.6%, so sub 4% is pretty strong on a historical basis. But this is really saying here that the risks of a downturn are continuing to rise. Now, of course, the most salient issue for consumers is the fact that they're seeing prices going up. They're seeing prices at the pump going up. They're seeing home prices, the mortgage rates on buying a home going up. They're seeing refinancing rates going up. And because of that, that's something that consumers are feeling very acutely right now for their own personal finances. But when it comes to thinking about the potential for a recession here and the current risk to the outlook, again, that interest rates are going to continue going up by the Federal Reserve, it really does speak to the fact that, you know, if you do have credit card debt, if you do have some of these higher interest rate debts or outstanding loans, these are things that you should maybe be thinking about paying down sooner rather than later, because at least in the short term and at least for the balance of this year, we are going to be seeing interest rates go higher by the Federal Reserve as they continue to hike.
Okay, so help me understand like some of this business speak. So I'm not going to worry quite yet, but are there any sort of buzzwords or phrases, something I should look out for that would give me an indication that, you know, the economy is sort of turning downwards or not?
Well, I think, of course, the main metric that economists have been looking for is GDP. And again, that rule of thumb is that once we get 2 consecutive negative quarters of GDP growth, that's typically what is used to define a recession. Now, we do have to emphasize that a recession is ultimately called by the National Bureau of Economic Research, the NBER. So they're the ones who ultimately have a say in it. Now, again, as a consumer, when you see prices continuing to climb, when you see your purchasing power getting eroded because, yes, wages are going up, but not quite at the same rate of inflation, it can make it feel like we're already sliding into something of a downturn now. So, of course, there is going to be a little bit of a discrepancy between what the Wall Street banks, what monetary policy makers, and what the average consumer may actually be feeling on the ground here. So I think that's ultimately something to really look for. Of course, GDP is going to be that main metric to look at. But then you have things like CPI, the Consumer Price Index on the inflation front, which again is really measuring the changes in prices that we're seeing across the economy. And that did last come in at 8.6%. Of course, a multi-decade high here, an unexpected acceleration from the prior month. So quite a few economic metrics to be looking at here. But again, when we talk about a recession, really are talking about that gross domestic product GDP figure.
All good stuff. Emily McCormick, thank you very much.
Thank you so much.